quickly get into a corporate conversation and then come back to you for some more stocks. The next management and company on our radar, actually City Union Bank. The stock has seen a fair bit of correction, along with, of course, the rest of the financial space in the mid-cap market. It's down about 15% so far in this year. Let's pull up maybe a one-year chart or a year-to-date chart that will reflect that decline that we're talking about. So 12 months, obviously, it's still up 8%, but year-to-date that decline became extremely steep. Now, one of the new initiatives that City Union Bank has announced is a partnership for co-branded credit cards with Chennai Super Kings. To discuss that and, of course, other business trends, we have Mr. N Kamakodi, Managing Director of City Union Bank. So thanks so much for joining in. This is interesting. So, a lot of the CSK fans, of course, will be looking out for this one. But just explain the strategy, the rationale. I mean, what are you expecting from your credit card business? Because in the past, I think your stated, move has been that you will grow the retail book more on the secured side. So what are you planning now on unsecured with this tie-up on credit cards?
Yeah, actually, the same strategy of, going with the secured retail continues to a greater extent. At the same time, we could, when we analyzed the data, our own customers have taken, part of a lot of credit cards and other retail consumption from other institutions where we are losing them from our side, and also it is very much required for our strengthening our retail liability base. So one product that was missing was basically the credit card, with extra focus with our existing customers, being City Union Bank, being having almost more than 2/3 of the business from, South India, particularly Tamil Nadu. We felt that it is very important for us to fill up the missing product offerings in our boutique. One of the products which we identified was the credit card, and we found that we have a significant number of our existing liability customers, particularly, are taking a lot of credit cards from the other banks, and ultimately the propensity for losing them appeared to be higher. So to bridge that gap, we have entered into a tie-up with, the Chennai Super Kings, which is ultimately the product which is having significant appeal to the cricket lovers of the state. And also we have very strong tie-ups with a lot of educational institutions in the state of Tamil Nadu, where the next generation students are also having a lot of interest in and association with the brand CSK. When that opportunity came, we felt that it's something which we have to enter into and have a strong tie-up, and that's why we have signed up with CSK.
So, Mr. Kamakodi, if I could just come in, get your point, but if we can get some numbers and projections, that will also help. In the third quarter, of course, your growth picked up. I mean, you've been growing the book at about 15%. Now, as we look at FY26, what would your outlook be for overall growth of the book? On the credit side, within that, how much would be sort of powered through retail? And if you could give the breakup of the retail book right now, how much is secured and how much is unsecured?
Basically, if you look into overall, we had a very, sustained and, decent credit growth in the past, and the calendar year 23 was sort of not a good year for us. When our, in December 2022, we had about 14 to 15% growth, which is slowly slipped to about 1 to 2% for December 2023. Once again, the growth picked up in the calendar year in 24, and we slowly and steadily increased it to about 15% for that. The current year also, we expect the growth to be between around the same number, plus or minus 1% or so. For the financial year 25-26 also, we hope we should be having 15-16%, 15 plus or minus 1% growth rate. In that, as we had multiple times given, the retail growth, in that 15% growth rate, the contribution from the retail may be between, 1 to 2%. Even in that, we expect the entire credit card portfolio will not be more than 1% of our portfolio in the overall portfolio in the for when year ending 31st March 2026. In that also, not less than 80% will be for our existing customer base, and our existing strategy of focusing more on the secured retail And particularly in the unsecured, it is only to support our existing customers, not to lose the existing customers, particularly on the liability base. So we want our liability customers, whenever they need the, like say, the credit card product, we don't want them to get into the other brands, other institutions and lose them. So the incremental portion will be minuscule. That's how we have become the credit card partner with the CSK to take care of that one.
Okay, so that makes it clear that you're looking to grow 15 to 16% next year, and the growth on the retail side will continue to be largely through the secured book, unsecured primarily to ensure that your customers don't go elsewhere if they need a credit card. So that's what the sense is. Just a sense on we've recently got more announcements from the RBI, right? Whether it is the liquidity measures. Then they've, of course, rolled back some of the prudential norms for NBFCs, etc. So for all the RBI measures that have happened, including the rate cut and the liquidity boost, the FX swaps, all of that, how has that improved liquidity conditions for you, and what do you see in the market?
See, what we feel, like say, as we have seen multiple cycles of interest rate hikes, interest rate lows, and also the tight liquidity condition and lower liquidity conditions. Like you had a period when it is repeatedly said that the retail depositors are moving more into the, like say, equity, and that's how the incremental deposit growth has started coming down, which is also part of the liquidity tightening. And also you had the government expenditures, like say that budget was not coming to the retail, commercial banking, but that was with the treasury and all. So all these things are, like say, slowly getting on the unwinding. And we feel when we enter into the decreasing interest rate scenario, the going forward in the next couple of quarters, the things will definitely improve. At the same time, whenever you see that there will be some adjustments in the yield what you charge because of the interest rate passing and all. Overall, things are getting better and better for the. We expect things will get better and better for the banking industry, both on the liquidity front and also on the growth front.
Okay, all right. So thank you very much for joining us. Good speaking with you and getting that perspective across.